Tom Graff, Brown Advisory Portfolio Manager and Head of Fixed Income, hops on Yahoo Finance to kind of break it down for us. And Tom, I just want to kick things off by pointing out that the 10-year bond kind of yield decrease has eased a bit this morning. But again, most of the noticeable action was yesterday. Is this the reflation trade blowing up in your view?
Well, I think, thanks for having me, Brian. I think there were some investors who thought that maybe inflation was going to continue to rise ad infinitum, and that there would never be any reaction from the Fed trying to control it. And I think what's happened these last 4 or 5 weeks has been that that narrative is reversed, where the Fed is now sort of talking about tapering. The dot plot moved up a little bit. And that's forced a repositioning amongst those that sort of had an inflation forever thesis.
How much of the move, though, would you say that we have seen over the last few days is justified? I mean, we're, to Brian's point, it hasn't been the kind of dip we saw yesterday, but it does feel like some of it could be overdone. Yeah,
we think a good bit of it is overdone, although that's obviously the million-dollar question. Look, in our view, that not that much has really changed. You mentioned as we were coming in the tight labor market in the restaurant industry, but that's everywhere where wage pressure is strong. And I think there was a time where the Fed felt as though it would be a long time before the unemployment rate had fallen enough such that the labor market would be as tight as it is now. And so this hawkish shift is really a confirmation that inflation can rise in the United States, and the Fed needs to be vigilant there. So while I think the repositioning has caused interest rates to fall, we still don't think this is the ultimate answer to the question. Ultimately, we think inflation is going to be somewhat higher here in the U.S. The Fed is going to react to that, and interest rates generally are going to be somewhat higher than where they are right now.
Tom, I asked this question of Art Hogan earlier in the morning, but how much of the dynamics that we're seeing in the bond market is attributable to international factors? Because I think we tend to have a very U.S.-centric view of what's going on in our bond markets. But, you see what's going on with the ECB, them tweaking their inflation language, not necessarily identical to what we have here with the flexible average inflation targeting regime in the United States, but essentially having something more symmetric where they would also tolerate for at least some periods above 2% inflation. Is that one reason why money might be coming to U.S. dollar denominated assets, simply because, look, maybe the ECB change says they're going to be on hold for longer as well? Go wherever you can find yield.
Yeah. So listen, I think it's a great point, Brian. For sure, the U.S. bond market is a huge market with all kinds of different players, including domestic and non-U.S. And starting about March, it was the case that for yen-based investors and euro-based investors and sterling-based investors, for that matter, that even after hedging the cost of moving into dollars, it was cheaper to own U.S. Treasuries than to own their home bonds. So that has definitely been a major flow issue here in the U.S. It's been a persistent one for a few months now. You mentioned the ECB change. The ECB saying that they want to get to 2% inflation is very different than the U.S. saying they want to get to 2% inflation. The ECB is dealing with an economy that hasn't produced inflation anywhere near that much on a persistent basis for years and years, whereas core PCE was over 2% as recently as 2018. So for the U.S., it's not that big a lift, but for Europe it is, and that may cement extremely, extremely low interest rate expectations there in Europe, cause real rates, so that's rates after adjusting for inflation, to be stuck at very, very low levels for a very, very long time. So I think that's all kind of incremental. I think this move by the ECB was pretty well telegraphed, but it illustrates kind of the challenge, and then frankly the challenge the U.S. will face if in fact inflation never rises.
And I guess that kind of addresses the demand side of the question when it comes to the bond market. But let's talk about the supply side. And I do tend to roll my eyes sometimes when people try to attribute movements in the bond market to quantitative easing or the longer asset purchases that the Fed is doing. But at the same time, there is something to be said that the TGA has led to a lot of interesting dynamics in overnight reverse repo markets. There's a possible debt ceiling that could make some changes, at least on the short end of the Treasury market. But are any of those things relevant in your view, or do you you think some of these things, zero hedge and the like, are being a bit overblown?
Well, a lot of things on zero hedge are overblown, but I think I think there's a kind of an unusual supply demand dynamic going on between things like the TGA and QE, like heavy bank deposits, and then sort of where does that money flow? So I think all those things are coming together to create this persistent baseline demand that is actually meeting surprisingly low supply on the front end of the yield curve. This is why kind of those repo auctions that the Fed have been running have been so heavily subscribed. So I think, I think all of these are reasons why, while I already said we expect interest rates to rise from here, we're not going to wake up from this like a fever dream and all of a sudden the 10-year is going to be 250. I think there's going to be some churn and some challenging dynamics between supply and demand that are going to be with us for a while as we exit kind of this extraordinary accommodation period.